Thank you for attending this webinar today, Small Business Tax Liability Reduction Strategies. I am your moderator, Jenny Alton from the New York Small Business Development Center. Also joining us off camera is Renee Goodnow from the central office as well. Today's presenter is Orumé Hayes, CPA, current Vice President of Chapters for the NYS SCPA, and founder and CEO of Hayes CPA LLC. Today's host is the Pace University Small Business Development Center. The Pace SBDC is part of the New York SBDC network of 22 campus-based centers and outreach offices, which are located across New York State. The NYS SBDC is a U.S. Small Business Administration SBA resource partner. Our free services are made possible by funding from the SBA, New York State, and our host campuses. So you know this session is being recorded. We will share it with attendees along with the slides a few hours after the presentation. Attendees are muted and will not be on camera. If you have any questions during the presentation, please don't hesitate to type them in the questions box as they come up. We will take some pauses for questions throughout the presentation, and there will be, time permitting, an opportunity for Q&A at the end of the webinar. If you submit a question, we will not mention your last name or business name unless you reference them specifically in your question. For very specific questions that may take more time and detail to answer, or if we run out of time to answer all questions, someone will follow up with you after the webinar. Joining us to lead things off today is the Pace SBDC Director, Andrew Flam. Andrew, I turn things over to you.
Great, thanks so much, Jenny and Renee. I really appreciate it, and welcome everybody. Orumé, I really look forward to your presentation, and we'll kick that off in just a moment. But first off, just wanted to spend a quick minute or two letting you all know who we are, what we do, and hopefully how we can be of help. So as Jenny had mentioned, my name is Andrew Flam. I'm the Regional Director of the Pace University SBDC, or Small Business Development Center. We're based in Lower Manhattan, and welcome you to today's session. Whether you're joining us from New York City or from elsewhere throughout New York State, our center, as well as our colleagues and counterparts throughout New York State, are all here to help you all build and grow your small businesses here in the state. Wanted to talk briefly about our range of services, which are all offered at no cost to you. So wanted to make sure that you're aware of that. Our focus is really on one-on-one business advisory services. All of the SBDC centers throughout New York State were all staffed by full-time business advisors, and their role is helping existing small businesses as well as aspiring entrepreneurs build their businesses, expand their businesses, and launch their ventures here in the state. Some of the key issue areas we work on a day-in and day-out basis is access to finance. Clearly an important item for you to consider as you're looking at growth opportunities, looking to be able to lease or purchase real estate here in the state, perhaps buy equipment or upgrade and expand your machinery, looking at kind of possibilities of being able to get more inventory on hand and so forth. So thinking about those opportunities and what might be a good fit for you, certainly things that our business advisors work on very frequently and are very proficient at. Also looking at marketing strategies, how to be able to build and implement kind of an effective social media campaign, how to be able to expand and build your website, incorporate e-commerce, and other marketing efforts to be able to attract and reach your target customer. We also look at a wide range of issue areas around government procurement opportunities. I know a wide range of certification programs that are in place to help small businesses be able to take advantage of those opportunities as they arise. And then finally, kind of looking at kind of a wider range of operational issues, whether it's implementing kind of formal accounting procedures, thinking about how to, kind of get a better sense of your bookkeeping practices. And then obviously over these last couple of years, thinking about the range of pandemic recovery programs that might be relevant for you and your business. So these are some issue areas that, again, our business advisors work on with folks on a day-in and day-out basis, all offered at no cost. And I'll put a link in the chat in terms of how to contact us, as well as to be able to arrange a session with a business advisor if you're not working with one already. In addition to the kind of the one-on-one services, obviously today is a really good example of timely and very, very impactful training programs that we work and collaborate with, some that we offer directly ourselves, and others through partnership arrangements like the session being handled today through collaboration with the New York State Society of CPAs. And it's been really, really beneficial, and we really appreciate Orumé Hayes, who, as Jenny had mentioned, serves as a vice president for the organization here in New York State, being able to join us as well. So thank you to NYS SCPA for your ongoing collaboration. We do have some other sessions coming up that will kick off after the new year. I'll put one or more in the chat for you if you'd like to join. I know we have one on bookkeeping best practices coming up in early January, and then I'll put a link to a wide range of other programs that our center, as well as my colleagues throughout the state, are going to be offering in the weeks to come. So we look forward to having you join for those as well. And then finally, I guess, as I mentioned, I will put also a link into the chat with respect to some of the key pandemic recovery programs that are in place. While some have expired, some from the federal government in particular, there are a range of programs that are in place that have grants, low interest loans, and others that are available through New York State and through some private organizations as well. So I'll stick a link in the chat for you for that as well. So that's a brief overview of kind of who we are and what we do. But I know with January 1st coming around the corner, I know you all want to start getting yourself prepared for the upcoming tax season. And there's no better way, I think, to be able to kind of look at that. And I think, today's title in terms of tax liability reduction strategies sort of hits the nail on the head in terms of what we're all hoping to do in terms of helping small businesses get a sense of what their responsibilities are, and then obviously to make sure they're well positioned to be able to handle that longer term. So with no further ado, wanted to introduce Orumé Hayes, who will be leading today's session. And Orumé, the floor is all yours. Again, really appreciate you leading this. Thank you very much.
Absolutely. Thank you, Andrew. Good afternoon to you, Jenny, and Renee, and to all of you out there listening who have logged in for this webinar today. It's a pleasure to have you here, and it's a pleasure for me to be here. And I want to say thank you also to the Pace University SBDC. Let me go ahead and share my screen so we can get started. And hopefully, I believe you can all see my screen now. So our topic today is small business tax liability reduction strategies. And so we're going to be talking about a lot of things that are applicable to you and to your business. So a little bit about me. I've been introduced, so I'm not going to take too much of your time. Currently, I am Vice President of VP of Chapters, as was previously said. I'm also Chair of the PCPS committee, one of the committees of the AICPA. Okay, I am also an adjunct lecturer. I teach accounting at the College of Staten Island, which is part of the CUNY system. I'm a business advisor. I've been a CPA for over a decade. And earlier on this year, I received an award, and I was named as one of 25 most powerful women in accounting. So I'm happy to share my knowledge with you, and I welcome your questions as we go along and during the chat. So first, so that's about me. Now I want to get to know a little bit about you. I know you're there, on the other side of the screen, and I cannot see you, but I would love for you to participate in this polling experiment that we're going to do. So pull out if you're on a computer, go to slido.com, open up a browser on your whatever device you're using, your cell phone, an iPad, and go to slido.com. There is a code that you're going to type into. Once you open up slido.com, that code number is 3763421. So these are the questions that I would like for you to just go ahead and type in your responses. Where are you dialing in from today? What city are you? What stage are you in your business? And what do you want to hope to get from this session? So if you go ahead and you can go ahead and type that in. Hopefully you guys typing it in, and if you can. Let's see. Okay, there we go. So Rochester, New York, I have a response. Rochester, New York, where else? Anybody else? I know I see a lot of folks are attending, so go ahead and just type in where you're calling in from, what type of business, where you're at in your business, and I'll leave that on for another 30 seconds, and I'll move on to the next slide. I hope you guys are not. And the link is also in the chat box. Wow, so now I get all the responses. Okay, so I have a couple of people who are in the pre-launch stage of their business. They're just starting. They want to learn about taxes. So a lot of things here. There is just trying to see, want to learn about expenses. So very good. So a lot of things that you guys are interested in. So let's go ahead and get started. Thank you all for participating and sharing in this. So our topic today, we're going to talk about cash flow. What exactly is cash flow and how do you manage it? That's what we're going to talk about. We're going to talk about owner compensation, very important. You guys are going to be running a business, or you're already in your business. You want to be able to be properly compensated. We'll talk about the ownership tax structure, how it affects other things that you want to do, mainly taxes. That's a primary concern for a lot of business owners. And then what is cash and accrual accounting? Some of you might already be familiar with these terms. We'll go over there. And then the last item that we'll discuss is depreciation. Depreciation can be very, very important for a lot of businesses. So we want to make sure you understand what that is all about. So cash flow, right? So cash, you guys have heard that the saying that a lot of people say all the time, cash is king. It really is. Without cash, you cannot run your business, right? Cash is the most liquid form of assets. When you have cash, there's a lot that you can do with cash. And we've just gone through this experience with COVID. We know that a lot of businesses failed during COVID when they had to shut down their doors. They couldn't get their customers in the door, into their stores. So they had no cash and they ran out of money. They had to close their doors. So cash is important because you really need to know what exactly is coming in, how much is coming in, how much are you bringing in into the business, and then how much is going out. Where exactly is that money going to? Do you have somebody embezzling your money, or are you spending it on the right things? Are you going out and having a flashy lifestyle, or are you investing that money into your business? It's really, really important for you to know all of this stuff. Cash can be, when we talk about cash, we're using cash in a loose term, right? So cash means physical cash, cashier's checks, bank checks, money market accounts. Those are short-term things that you can more easily convert into cash. Okay, so when we talk about cash, we want to know a couple of things. Where is that cash coming in from? So money, it's the amount of money that you're getting, your sources of revenue, your customers. Who are your customers, and where is the money coming in from? Do you also have money coming in from founders, from investors, from the bank? You want to know where that money is coming in from, because when you have employees, your employees, they need to get paid. You're not going to give them an IOU and say that, well, you're going to trade or you're going to barter services. So you need to know exactly what is coming in. If you've performed your service, you've built let's say you bake you have a bakery, right? You've sold your things. If somebody comes into your bakery, you're going to get cash immediately, right? Because obviously they're not going to take that baked goods and come back and pay you. However, if you're in construction and you're billing your clients, that you have a payment, you have stages in the service that you provide. So you're not going to get paid immediately. So you need to know where the money is coming in from, because the funds, the money you get, that cash is what is going to make you able to pay your bills. If you have laborers, if you have staff, it's very important. You have to be able to pay your employees. If you're a solo practitioner, Right now, you don't have payroll, you don't have staff. That's okay, but there are other expenses that you have as a business owner, right? Maybe you have rent, you have to pay expenses, you have a location and you're paying rent. That needs to get paid. You're not going to tell your landlord, well, I'm a little bit short on cash this month. Can I pay you back, pay my rent next month? Sometimes they'll give you a little bit of leeway, some wiggle room, but that is not something that you want to get into the practice of doing as a business owner. So this is really going to have you take a look at your ability. Once you have cash, it's going to tell you, are you able to pay your bills on time, right? Your utility bills, when they come due, are you able to pay them on time? Your transportation, if you're in a business where you are having to move around from location to location, are you able to do that? So these are the things that we're going to look at. We're going to look at cash, money coming in, right, from all your sources of income, from your customers, from the bank, from your investors, and then we'll look at cash going out. That is what this is all about. It's very important that you need to be able to evaluate what is going on. And to do this, what do we use? We use a cash flow. We use a cash flow report and a statement of cash flow for evaluating what our cash position is in our business. So, like I said, we're looking at money in, money out, right? Cash is coming in, money is coming in, and money is going out. So what are our sources of inflow? Money coming in, our sales. Sales is anything that is, you're getting cash paid upfront, or it's also receivables, accounts receivables. So for example, as a CPA, as a tax preparer, when I prepare a tax return for my clients, the services are paid for before I file the tax return. So I'm getting paid immediately, similar to what I said. But you have a situation where you are providing services for which you have to bill your clients, right? You have to send them a bill. So you're going to have a little bit of collection issue going on. You're going to have accounts receivable, because when you provided that service, whether it's a design service or whatever it is that you do, you're not going to get paid immediately. So you have to wait for collection. So you perform the service. You might have to wait 30 days or 60 days for collection of your money, right? That is going to, you are going to factor that in, but you have to realize that you cannot rely on the funds to operate your business this month, because you might get paid in 2 months or 3 months, right? Loan proceeds, that's another way of running our businesses. If you are not able to get cash immediately from your customers and you're able to get a bank loan, that is a way that you use that money. Money is coming in, like we said, cash is king. It doesn't matter where you get the money from, as long as you have the money to keep your business open, to keep the doors open. The same thing with equity. Equity, that's when you have an investor, you're getting money from an investor. Somebody believes in what you're doing, believes in in that app that you've built, or in that new idea that you've come up with. So they believe in your strategy, and so they've made an investment in you. They're going to give you the funding that you need to be able to operate your business successfully. So these are sources of cash inflow. Now, what happens? Cash comes in. Of course, at the end of the day, or every day, as you get engaged in the day-to-day operations of your business, what happens? You will start to spend that cash. Cash is going to begin to go out. And so what are the types of things that we have when we're talking about cash going out? We're spending cash for operating expenses, transportation, rent, to design your website. You have to design your website. You have to hire experts to provide services, hire an attorney, an accountant, a CPA, those are part of your operational activities, right? So if you have employees, you have to pay your employees. You have to spend cash on all of those activities, so money is flowing out the door. Accounts payable, you have gone to you purchase items that you're not paying for immediately. If you are a retail store, you have a store on Fifth Avenue, it's a very expensive location. So if you are able to get a location on Fifth Avenue or downtown in Chelsea somewhere, wherever, so you have a merchandise store, you're going to get your inventory from someplace, right? So you purchase inventory from your from the seller, from the wholesaler, but you have not yet paid for that inventory. So what's that? You have an accounts payable. You have to make sure that you pay your wholesaler eventually, because otherwise they will stop doing business with you. So you have accounts payable, bills, your utility bills. When you get when those are bills, companies that bill you monthly, right? Your utility bills, your telephone bills, you get bills in the mail. At the end of the cycle, you need to make sure that those bills are paid immediately so that your services don't get turned off. That's accounts payable. Money is going to go out the door. Equity payment. If you have an investor that you've gone into business with and you have a kind of arrangement with them, they're supposed to be getting dividend payments. Those are whatever the contract, whatever the arrangement is that you had with your equity investment, you want to make sure that you always fulfill your end of the bargain. You never want to disappoint your investors. So those are some of the sources, some of the things that are that you need to evaluate. So to get a picture of how you need to do your projection, you are going to have to figure out what are you expecting to come in the door and what are you expecting to go out the door every month. So to do this, you use a monthly cash flow report. So what you see here on this report, you see the first column. This tells us, let's say this is the second year in operation for this particular business. They are starting the month, right, the new year, they're starting the year with $18,000 in the bank. So now you're going to prepare your estimate for the full year. And when you're doing this, you should always do your projection. Either do a projection for 6 months at a time or do a projection for 12 months for the full year. So these are just some broad categories that I've indicated here. You can put in as many specific line descriptions as much as you want to. Okay, so we have cash coming in. For this particular business, they're expecting to have sales of $50,000 for the year. From the last month, let's say the prior year, December, they sold services of 12,000, maybe they sold more than that. Let's say they sold services of 100,000. Out of that $100,000 of services they sold, they did not collect $12,000. So that's why they have accounts receivable of $12,000, and they think that they'll be able to collect the $12,000 this month, in the month of January. And then loan proceeds. Based on some analysis that they've done, they know that they need to, maybe they don't have enough money to cover payroll. They ran into a huge expense last month. They have to go, they have a line of credit. They're going to go draw on that line of credit or apply for a new loan. So they're factoring, they're projecting that they can get $10,000 from the bank. So in total, they're going to get a cash inflow of $72,000. Now, you've done the inflow analysis. Let's do the outflow analysis. For the month, all of your operating expenses, all of the bills, staff, location, transportation, design, whatever it is, marketing, advertising, those expenses, they're going to cost us $45,000 for the month. And then we have accounts payable, bills that you already received in the mail that you need to pay this month so you avoid late service charges. That costs $50,000. So we see that our total cash outflow is $50,000. Now, when you look at it, when you do your calculation from our cash inflow and our cash flow outflow, our monthly cash balance is $22,000 and our cumulative balance is $40,000. How did we get $40,000? That's the $18,000 that you started the month with, plus the net result of what you have, what you brought in and what you spent for that month is what gives you your cumulative balance. So, and then this is what you're going to use to start the next month. So we figure out, we go to the next month, we're starting February, the month of February, which for the $1,000. And then I'm not going to go through all the numbers in detail, but just so that if you guys follow the flow of what I'm saying, and feel free to ask questions if you want me to go over any of the numbers or clarify anything, let me know. So you do your analysis for how much cash you're expecting in the second month. So we see that in the second month, we're expecting total cash collection of $45,000. And then for our expenses, look at that. We have high expenses expected for the month of February, $70,000. A huge part of that is our operating expenses, jumped up to $58,000. You probably got a discount maybe from your landlord when you first moved into the building. They gave you a discount, and then for future months, you're now brought up to the market rate. So you're in total, whatever that expense was for, it increased your total expense for the month. So we're now at $70,000. So what does this mean? That means we're going to have a deficit for the month, right? We are only going to bring in $45,000, but we intend to spend $70,000. So we have a deficit of $25,000 for the month. Now, the good thing is what? We had money in the bank, right, when we started the month. We started the month with $40,000. So even though our monthly activity had a net effect of $25,000, we still have a positive cash flow, right, $15,000. Now we go to the next, this is the way you do it. So we go to the next month, March, we start with $15,000. We see our total expectation for cash collection for the month of March is $75,000. And then our total expenses, we expect to spend only $35,000 for March. So that means that we're really doing good. March is a good month. We're not spending as much money, so we have $40,000. And so our cash position at the end of March is $55,000. So this is a very, very important step for all business owners to go through, because what this does is that based on what you project for the full year, then all businesses go through different stages, right? You know that in the month of March, if you as a business owner, if you are, sometimes depending on where you're at and how much revenue you're making, you're expected to make estimated tax payments. Those tax payments, they're paid at specific times during the year, maybe in January, April, June, September, or you might make a payment in December. So you're going to have certain months where your expenses are going to be high, and other months where your expenses are going to be low. So you want to make sure that you take care and you make the appropriate analysis for the full year, so that you know in this month, in the month of June, we're going to have a lot of expenses, but we don't have enough projection coming in for cash inflow. So what does that mean? That means that maybe that's a month where we need to draw on our credit line, right? Maybe that's a month where I need to go to the bank and get apply for a loan, so that you can get those things, do those things in advance. And your employees, if you have employees, everybody gets paid. We want to make sure that that is being done. Okay, so let's go through the next thing. What happens next after you've done that? So this is after you've done the monthly projection, then you want to look at the full picture. What happened at the end of the year, so that you can have a better grasp of how your business did. To do that, we need to prepare what is called a cash flow statement. And to have a cash flow statement, we prepare that report from all the two other financial statements, the income statement and the balance sheet statement. Now, I know most of you are familiar with the income statement and the balance sheet. Those are statements that people are, it's easy for them to understand. The one that a lot of people don't utilize, but it's very important for business owners, is the statement of cash flow. So I just want you to take a look at, these are just sample numbers that I have here. If you take a look at the net profit from this income statement, it says the net profit was 25,000. So for this particular business, they made over $1 million in sales, but the net profit was only $25,000. So again, how does this affect your business, affect your cash flow? You take a look at it and look at the analysis. So let's go a little further and look at the analysis. All right, so this is the cash flow statement. So this report, you know, you don't have to, when you look at financial reports, and you know, you want to make sure that this is something that you're reviewing with your accountant, with your CPA on a regular basis. The cash flow statement will be annually, or you could review it every 6 months. For the monthly cash flow, you definitely want to have that. But you want to go through this analysis because the picture that this report gives you is totally different from the income statement. Whereas the income statement said that you had $25,000 net in profit, you know, the cash flow statement would tell you something else. So we see that this statement is for the period of 2021. We see that at the beginning of the year, this business started they started the year with $18,000 in cash. So now what this report is going to say is, where did we make cash, and where did we spend, what did we spend cash on? So there are 3 sections. When you're looking at a cash flow statement, there are 3 sections that a business owner that you want to look at. The 3 main sections are the first one, which is what you do, your operating activities, the day-to-day activities for your business. What is that? What was that involved in? So we see that the first line item there is the net income. This was on the previous slide that showed you the net income statement. It showed that the net income was $25,000. We want to see exactly what the cash came in, and what the cash that went out. What was it? So accounts receivable increased by 90,000. So that is cash that you did not collect. There was bad debt that was written off. Accounts payable, that means you paid accounts payable bills that you paid. And then we have accrued liabilities and income taxes paid. So we see that our operating effect, the effect for the full year, based on our operating activities, cash that came in and cash that went out the door, we were negative $30,000, $30,264. So even though we saw that at the beginning, we saw that we had net income, you know, this is why this is critical for you to be able to look at this report. Even though we had net income of $25,000, based on our operating activities, things that we're doing to grow our business, we have a net negative cash flow. Then we look at the next section of the cash flow. That's investing. What is the investing activities? Investing activities are things that you do to invest in your business, to help your business grow, to help your business become more profitable. So if you're buying a tractor, if you're buying land, if you're buying a vehicle, you have a flower shop, right? You're buying delivery vehicle, or you run a transportation business, you're buying a fleet of vehicles. Those vehicles will be regarded as investment activities. So when you purchase those vehicles, those will be a cash outflow because you're spending money to purchase those assets to help you run your business. When you sell one of those assets, those investing assets, when you sell them, then you'd get cash, and you'll be able to use that cash for other things in your business. So that would be an investment activity, cash inflow. So you see here, there was a fixed assets outflow. They purchased, for this particular company, they purchased an equipment worth $16,000. So that is why that's a negative. That is a cash outflow. That equipment that was purchased was critical for them to, it's a critical asset for them to use to operate their business, for them to use to run their business. Then we look at the third type of activity that is analyzed in the statement of cash flow, that is financing. So what is financing? This is when you are financing your business through other sources, whether from the bank or from other investors. So for this particular business, they had to pay back a loan of $20,000, and then they also at the same time maybe they had an agreement, a payment that came due, so they had to make sure that they made that payment so they wouldn't go into default. So they made that payment of $20,000. Then they went to another bank, and because they still needed help with financing, and got another loan of $10,000. So I just finished with it. I'll go back up to the operating section. So we see that is 30,000. We only had one activity for the investing section. So the net effect in the investing section was an outflow of $16,000. And then for our financing section, the combined result of the activity is an outflow of $10,000. So when we look at that, the cumulative three areas: one, what went on in the operations of your business; two, what went on in the investing section of your business; and then three, your financing section of the business. The cumulative three areas, it's a net cash outflow of $56,000. So when you combine that to the original $10,000 that you started your business in, what do we have? We have a net cash outflow of $38,000. So when you do this analysis, you're thinking, why am I doing this? What is this? This is going to tell you that you need to look at the certain things that you need to look at in your business that you want to be aware of. One, you want to know where your cash is. For this particular business, they're not doing well on cash. When businesses don't pay attention to what's going on with their cash, that is why businesses go under. You see, I'm sure some of you have seen signs where you've seen a business is in operation. 3 months down the line, you walk down that street, and what do you see on the, or maybe 6 months or a year later, you walk down that street, what do you see? You see a sign that says going out of business. Well, what happened? They were not paying attention to their cash flow. They were in the business of just operating their business on a regular basis and not paying attention to what was going on. So what are some of the things that, and I don't have this on a slide, but I'm just going to talk about it. Some of the things that sometimes businesses don't evaluate when they're looking at all their costs. Sometimes if you're in merchandise, you need to make sure you're taking into consideration all of your shipping costs. That is expense. Sometimes you might not do a proper calculation, so that's why you have to involve a CPA or an accountant to make sure that you're capturing all the different expenses that you need to pass on to your clients. Just like other clients, just like the telephone companies, the internet companies, all of their, whenever they have additional costs, they pass it on to you. The airline companies, airfare, those tickets, the prices go up all the time. Once there's a little spike in gas prices, in oil, you need to take all of those things into consideration and make sure that you're passing on applicable prices to your clients. If you need to increase your prices, and then look at areas where you can reduce costs. If you're selling inventory, do you have inventory, obsolete, old, outdated inventory sitting on a shelf? That is money. That is money just sitting on the shelf. You need to get rid of that inventory, cut your prices, sell it out, so that you can you're not holding on to bad, outdated inventory in your store. You need to manage other expenses. Payroll is usually the biggest part of any business, part of running any business. Do you have too many people on your staff? Do you need to tighten your belt? You need to make sure that you're evaluating what your payroll cost is. How many subscriptions, how many licenses do you have? How many subscriptions do you have? a lot of times people sign up for things, right? We get an email, we get the introductory free enticements to register and to enroll for a subscription for a service or for a product. And then after a while, what happens? The business, you stop using it. You need to cancel out any subscriptions that you're not using and to make sure that all the licenses that you're using are providing value for your business. Look at your professional fees. Are you paying for anything that you shouldn't be paying for? You know, just look at ways that you can be creative and you can reduce your expenses. This is going to help you with your cash flow. Another thing you want to monitor is your cash receipts, your cash intake. If you're in a business where you're billing your clients, you want to make sure that you're following up on collections timely. So a lot of time, if a business is, when a business is, if your accounts receivable is more than, let's say, the standard is about 7 months. If your accounts receivable is more than 7 months past due, there's a very, very high likelihood that you're not going to be able to collect from that client. Which is that anyone here that pays a bill, you know, if you have a sibling, a friend, somebody that owes you money for a couple of months, do they ever come back to you and say, hey, here's the $1,000 you loaned me, you can have it back? No. So you want to make sure immediately it's 30 days past due, 60 days past due, follow up with your clients, follow up with those customers, and let them know that you want to get paid. You know, stop providing service, whatever that service is that you're providing to them. Stop providing service, and then let them know that you're going to follow up. And if they don't pay you, you want to follow, refer that to a collection agency as soon as possible, so that it never gets to that delinquent stage. Because what it is, the other business, they're using your money to finance their business. If they are not paying you, that's cash that's not coming in the door for you to operate your business. And then on the other side, on the flip side, you on the other side want to try and delay your payments as much as you can. So there are times that business will offer you a discount if you pay on time. So they might say they'll give you a 2% discount if you pay with your bill within 10 days. If you can take advantage of a discount, always take advantage of that discount. However, if their payment terms are net 60 days, you want to take advantage of that 60 days as well. Don't pay your bills within 30 days or within 20 days just because you have that bill in your hand and there's currently money in the bank. No, if your invoice says the net is due in 60 days, you want to wait for 60 days before you pay that bill. So there are lots of creative ways that you can do to be creative to manage your cash flow. Negotiate with your vendors, shop around, compare prices. All of these things will go really should be considered when you're looking at the overall picture of your cash flow. I hope that helps. Okay, so let me go back to share my screen and then go on to the next topic. So let's talk about compensation. So compensation, this is how do you get paid? Are you taking a draw? Are you on payroll? Are you just paying your personal bills out of your business account? So this should be, you go back to if you still have your browser open, go on to that page and you can type into the box, and this will give me, okay, there we go. Not sure what happened. Let's see. Oh, there we go. So we have some folks taking distributions and withdrawals. Anybody on payroll? Anybody paying themselves through payroll currently? Okay, so hopefully no one's paying their personal bills, paying themselves by paying their personal bills. So let's go ahead and talk about it then. So these are the ways that you can pay yourself when you have a business, right? The first one, obviously, is a salary. What is a salary? You guys are familiar with that. If you were employees before you started your business, the salaries is the recurring payments, something that you receive on regular intervals, whether it's monthly, bi-weekly. So that is the salary. You want to make sure that you have an idea, and we'll discuss a little bit more about the salary and how it's if that is an ideal way for you to pay yourself. When you have a salary, you know that you have a set thing. Just like you have set expenses every month, you have to pay your rent, your personal rent, not your business rent. You want to make sure that you have enough income from your business to be able to maintain that personal lifestyle that you have. Another avenue, another way that business owners pay themselves is to pay themselves a bonus or a commission. The bonus is usually calculated at the end of the year. Once you run your financials, you see how well the business did, and then you can decide, okay, the business was really profitable this year. Let's go ahead and take a bonus, and then you can do some kind of calculation. Your accountant will help you with it. If you want to take a 20% bonus or 10% bonus, or based on the results, on actual results of the business. Commission. A lot of businesses don't necessarily pay themselves commission. However, there are certain times that you might want to think about paying yourself a commission if you are doing the business of a salesperson, right? You're going out there and you're soliciting sales, you're making sales, and you know that down the line, you're going to end up hiring a salesperson. So you want to get into the habit of paying yourself a sales commission for that work, because it is going to now, you want to keep your financials regular so that you can see what it is, what your projection for commissions are going to be. So if you're, if let's say you've had your business for you've operated the business for 9 months, you don't have there's no commissions on there for 9 months, and then in the 10, 11, 12 months you have commission. It's okay, but if you've been paying yourself that commission and then you hire somebody in the month of November or October, your financials are going to be comparable, because it's going to see that you had commission expense because you were doing the work of the salesperson. You had commission expense in the month of April, May, June, and so it carried over. So that is just one way that you can think about if you want to be strategic and talk about paying yourself and your employees, pay yourself compensation. Other ways that you pay yourself is to take fringe benefits. Medical costs, if you have your health insurance as a self-employed person, or if you have employees, you and your spouse, within the tax law, you can pay yourself and your spouses the benefits, the medical costs will not be taxable. The value of the medical costs is in the tax law, it will not be taxable. Other fringe benefits. Now, if there's a caveat for when you get fringe benefits, I think it's been in the news lately, right? That I believe the executive from the Trump organization, they were just recently found guilty of violating some laws, because they were being highly compensated for lodging, for accommodation, for tuition for their children, and those expenses were not reported on their taxes. So you want to be sure that the expenses, that the fringe benefits that you're giving to yourself or to your employees, that it will not be regarded as compensation for services. So fringe benefits that is given to everybody in the organization that is not part of reward for work that you've done, that is allowable fringe benefits. But if it's another way of paying you, so to say, then that's going to be a taxable fringe benefits. So when you're doing your analysis, you're going to look at the different options. What is a taxable fringe benefit, and what can you get away with that is non-taxable. You want the non-taxable fringe benefits. And then other areas, draws, you're taking money out. Every time you take money out of the business, that's a draw. As a sole proprietor or partner, and I'll talk a little bit more about this in future slides, that's a draw. Dividends, that is for a corporation. You're taking money out through the dividends. Stock options, we'll talk about that. Other areas that you can compensate yourself, and I'm not going to get to this too much in this conversation today, is about retirement contributions. That's another way that you can compensate yourself. You can, put money into a retirement program, a Roth of solo 401k, or a traditional IRA. So there are different programs. Some of them require you to set them up in advance, and some of these programs you can simply open that retirement account before you file your taxes in April. So that area is a very involved area, and so that would involve a different conversation. But that is something definitely that if you're not involved in right now, and if you have a profitable business and you have the cash flow, remember we spoke about cash flow. There's a difference between wanting to participate in something and then being able to pay into it. So what I always tell my clients, sometimes when they owe a lot of taxes and they're not making any payments into their retirement plan, I said, you want to give your cash to the government, or do you want to give your cash to your future you? So that you, when you retire, if you contribute money into your retirement, that is planning for your future, right? So that is a very good use of your cash. So my recommendation would always be, if you have the cash flow in the business, go ahead and make a contribution to a retirement plan, and then that will definitely help reduce your tax liability at the end of the day. So what are the different structures, the different areas, how folks pay themselves. As a sole proprietor, when you take money out of the business, basically you're taking a draw. There is no difference between you and the individual and the sole proprietor. Even though you might have an EIN number, an employer ID number, you're filing on the Schedule C, you're not filing a separate tax return. So any money you take out of the business, it's basically, it's a draw. It's regarded as salary. As a sole proprietor, you are not required, you don't run payroll. So you can take money out of the business, and whether you're paying your personal bills or you're paying the business, when you're paying the business bills, that goes into the calculation of your net income. When you pay your personal bills, that is regarded as a draw. Now, the main thing though for the sole proprietor is that your net earnings, what you have left at the end of the day, you're going to be taxed on it. You're going to be taxed on it for Social Security, and then you will also be taxed on it for income-wise. But the sole proprietor method option is a very flexible, informal method. If you were not sure which kind of structure you want to go, whether you want to have a partner, you want to have a corporation, you can open your doors tomorrow and be a sole proprietor. So that's the most flexible method of business ownership and business compensation as well. Now, how do partners get compensated? So the partnerships, you usually when you have a partnership, you want to always have a partnership agreement. So there should be a structure, an agreement in place that says partner X is going to get this amount of, if everything is not 50-50. The unwritten agreement, if you don't have a written agreement, the split is usually 50-50. However, people bring different things into a partnership. So you want to, if folks are bringing in different things, some people are bringing in skills, talent, some people are bringing in the financing. So based on the amount of work that the partners are involved in, you could have a different sharing structure. So the amount of draw that you receive as a partner is going to be based on what you have in your partnership agreement. If it says you get 40% or 30% or 70%, whatever it is, that is the draw that you get, that you can withdraw. And it's going to be limited if you have a loss, you can sit down here. It says your losses are going to be limited to your adjusted basis in the partnership interest. So how much do you have invested in the partnership? That is what your losses, how much you can deduct. You'll be able to claim as a loss against, if you have any other income, against your other income on your tax return. So for the partners, you usually get a K1. The K1 is similar to a W-2, which employees get. You get a K1, and on there is going to have your pro rata share of your income or loss, and then you use that to file your tax return. Now we get to the S corporation. This is the one that a lot of people usually trip up on, because the school of thought is that with the S corporation, that is the most friendly method for you to be able to avoid taxes, for you to be able to pay less taxes. Yes, but there is a caveat. So with the S corporation, you have to take what is called a reasonable salary. You know, I believe this happened sometime in the 70s when the strategy of forming S corporations coming out and people taking money out of the S corporation, because the S corporation, the S corporation and the partnership, they are called flow-through entities. And you might have heard that terminology. They're flow-through entities because even though you file tax returns for those companies, those two entity types actually they don't pay any tax return. They prepare the tax return, and then they give their partners and the shareholders what is called a K1 for them to file their taxes. Okay, so the corporation itself doesn't pay taxes. So because of this, the folks that business owners, S corporation owners, they usually want to try and minimize their net income, because that is what they're going to pay tax on as the shareholders. They're not going to pay tax, they're going to pay income tax on the net income. They're not going to pay self-employment tax on the net income. That is where the savings comes from, self-employment tax. Partners, they have to pay self-employment tax because they're regarded as self-employed, except, I should mention this, except if you are a general partner. So the general partner is the person that actually does the day-to-day operation of the business. If you're a general partner, you know, you have to run payroll, you have to take payroll, and then the partnership is able to deduct your payroll. But if you are a limited partner, you're considered self-employed if you're a limited partner, so you pay self-employment taxes. Going back to the S corporation, so the strategy that people usually do is that they want to reduce the amount of salary that they take through the corporation so that they save on the self-employment taxes. That is the 7.65% from the employee, from the individual, and then the additional the employer portions to altogether 15.3%. They want to be able to save on that, so they don't take out any salary per se, and then they take most of their money as a distribution. Most of the money that they take out as a distribution so that they don't pay taxes on it. What the IRS has said is that this is a very, very dangerous thing to do. You want to look at these factors that I have listed here. These are just some of the factors that you need to consider, not all of them. Because what happens is that if you end up taking, let's say you end up taking $200,000 in distribution, but you took out zero as salary compensation, the IRS is going to say, no, you were working in the company, you were providing services for the company, we are going to reclass all of those distribution, all of that money that you took out of the business, we're going to reclass it, and we're going to you're going to have to pay payroll taxes on it, federal unemployment taxes, state unemployment taxes, and we're going to charge you penalties and interest. So in order for you to make sure that you are compensating yourself properly, and you don't want to undercompensate yourself. Again, you don't want to take $500,000 in distribution and then maybe take $20,000 as your payroll wages. So when you are analyzing how much should I pay myself as an S corporation person, you're going to look at your training and the experience. What is the work? What services are you providing for your business? How much training do you have? You have technical training as a CPA, as an attorney, as an architect. You're going to look at it. What are your duties and responsibilities? Are you in charge of signing contracts? You know, are you making sales calls? What is it that you're doing? You're going to look at your time and efforts. You're spending all of your time, you know, working 40 hours or more, or are you only working 5 hours in a business? That is going to be taken into consideration. What is the dividend history? You paying if it's a business that has been in operation for a few years, are you paying dividends on it? What do you pay bonus? Do you have other employees in the business? Does everybody get a bonus as well? What are other businesses, comparable businesses, getting in your area? What are they getting paid? So you're going to evaluate. Do you have a restaurant? Is it a chef? Is it that you're paying? What is the chef getting paid? Is it you have a beauty salon? You have to look at what are other people in your line of business, whether it's a service or program, what are they doing? If you have a salesperson, let's say it's an automobile, it's a salesperson, what are they getting paid? What is the showroom down the road? What are they paying their salespeople? It needs to be comparable. So what happens is that you're going to do this analysis. I don't expect you to do this analysis yourself because it's very complex. It's a very complex analysis. This is what you approach your CPA, your accountants to help you come together to determine that you have a good number in place. So first of all, you're going to look at how the business is doing, and then you look at all these factors, and then you come up with a structure. So you can have, for an S corporation, you want to have the right combination of salary payments and distributions. So if you're taking, let's say you're taking $200,000 in salary, well, and then even if you take $500,000 in distributions, the IRS will not come after you because maybe that $200,000 is the right amount of compensation for what you're doing, for your skill of service, for what you're doing with that company. So you're not going to run into trouble with the IRS. Okay. So when it comes to the S corporation, one of the big things about the S corporation, and I see we are almost coming to how much time. I'm just doing a time check here. How much time are we doing, guys?
I did let folks know, or I will in a moment, that we are going over the hour mark right now. So if folks do need to jump off, they will receive the recording. If you want to maybe go another 5 minutes and still have time for the Q&A, I think that would be great.
Okay, great. Thank you for that. All right, so the S corporation is they're subject to double taxation. So S corporation, the thing with the with the C corporation is that when the shareholders take out a salary, that salary is deductible. The business deducts that salary, and then the business pays tax on the net income of the business, and then any money that you want to take out of the business is going to be taxed as a dividend. So when you're considering which structure you want to use, you want to look at these different factors. The sole proprietorship is a flexible structure, but you remember you're liable for self-employment taxes. The partnership, that is you want to look at, do I want to have limited liability, or do I want to be responsible for all the debt of all the partners in the business? That is something that you want to evaluate. Do I want to be management, or do I just want to invest and not be involved in management? And do I want to work with other people? And remember also, you're going to be liable for income and self-employment taxes. The S corporation, again, you have limited liabilities. What you invest in the business, that's where you're going to you're going to be subject to losing that amount. And then do you want to be involved in it? You want to look at your income taxes. So you want to evaluate these things as to what your what type of entity structure is good for you. Corporation, usually founders, if you have a startup corporation, you intend to go public or raise money from the public at large. This is the type of business structure entity that most businesses, most business owners will go into, because they want to be able to raise capital. They want to be able to raise capital. This structure definitely has limited liability. So I didn't get to this accrual versus cash. So when you are recording this, this is all very self-explanatory. Usually with accrual, you're recognizing your revenue when you perform your services, whereas cash is when you actually collect cash. So a dry cleaner, you go to a laundromat, you get your dry cleaning, you pay cash to the dry cleaner. Right then, the dry cleaner is going to record the revenue in that month. If the dry cleaner was using the accrual method, they perform their service, right? But you don't go to collect your dry cleaning until 2 months later. 2 months later, and then they pay you cash 2 months later. The month that they perform the service is when they're going to record revenue. And so that's the difference basically within cash and revenue and accrual. The same thing with expenses. When you spend, when your employees pay, do the work, they work for you this month, they have earned their wages, so you're going to accrue their wages even if you pay them next month, or because of the cutoff of the end of the month, even if you pay them next month. So you accrue expenses in the month that you use up those expenses. You're doing cash, it's whenever you pay that cash. Usually, one thing you should know is that usually, if you're using the cash system, you do not have bad debts. You hear people sometimes talk about bad debts. You can only have bad debts if you use the accrual system. This means that you have billed your clients, you recognize that revenue, you show the revenue on your financials, but you have not gotten paid the cash. So that is when you have cash. Depreciation, really fast. Depreciation is when you are allocating whatever, if you have a big ticket item. So let's say you're buying vehicles, you're buying a lot of furniture, you're buying real estate, so these are, you cannot take the deduction in 1 month. Those are big ticket items. You want to be able to spread out the deduction and recognize it over a period of time, over the useful life of that item. So this is just a way to recognize the cost for your assets. Big, really fast. De minimis expensing is when, if you buy a item, let's say you buy a laptop, a new computer, any item that you buy up to $2,500, you can take that deduction immediately on your tax return. You don't have to spread it out. Usually, with the way depreciation works, you spread things out 3, 5, 7 years, depending on the lifetime of that activity. But in this case, with the tax law, you can take a deduction of items up to $2,500. And then the new tax law, which is expiring this year, 2022, is the year that we can take the 100% of bonus depreciation. So there's sometimes that you buy some high ticket items, you can take that 100% deduction. Starting next year, in 2023, it's going to start to scale down 20% every year. So next year, you will only be able to take 80% of the deduction. And then the last one that I want to talk about is the 179 deduction. If you have expenses, you can deduct an expense up to $1 million. I don't know if any of you have expenses up to $1 million, but if you did, if you do, you can use the 179 election to take that deduction. And basically that's it, folks. Thank you so much. I know I went over a little bit, so I want to thank you guys there. If there are any quick questions that I can respond to, otherwise I want to hand it over to you, Renee.
Absolutely, we did get some good questions, and also Andrew and I both dropped a bunch of stuff in the chat to save a little bit on time during the Q&A. Andrew, did you have anything to add to that while I get our questions organized?
Yeah, I guess I'll just go through them real quickly. First off, Orumé, thanks so much. It was really insightful and really some wonderful comments. A couple of quick takeaways I dropped in the chat, but sort of thinking about the things that you kind of touched on, I think that are so important. I think understanding your future business finances, sort of thinking about like what the process looks like, what your future is going to look like, and being able to come up with what Orumé was sort of talking about in terms of financial projections, which is so crucial for your own business planning purposes, whether you're going to want to look for financial support through a loan or some investment. Being able to kind of come up with that and be able to understand that, I think is so important, and I appreciate you referencing that. The variety of expenses and profitability, clearly a lot of businesses, you look at certain months where, massive amounts of revenue are coming in, maybe some big expenditures, so being able to even out your cash flow and being able to have, whether it's a working capital loan or maybe some sort of line of credit in place, to be able to have that availability, be able to even that out over time is so important. And that's, again, something you can work on with the SBDC business advisor. A third item was kind of evaluating your individual expense lines. How are you doing? And Orumé kind of, very smartly kind of looked at a lot of different categories, is your personnel level high? Is your cost of goods sold high? How does it compare to industry standards? To be able to tie that in and look at how some of your competitors are doing, and your business advisors can help you with that as well. And then finally, I think most importantly is, I loved how you kind of went through in terms of making sure you have sufficient cash on hand to be able to operate your business. Cash is king. So from an accounts receivable perspective, making sure that you have that formal process in place, because if you're doing the work, you want to make sure you're getting paid in a reasonably timely fashion to make sure you can keep your doors open and keep being able to build and grow your business. So those are a couple of key things I wanted to kind of make sure that I reinforced and thought were really great and very, very applicable to kind of how our clients operate. So Orumé, thank you so much, and I'll turn the floor back over to you all.
Thank you. And Andrew, you might want to stay on, because some of these questions might be a better fit to follow up with you and your team, because they might take a little bit longer to answer than we have during this Q&A. But I'll start with the ones that are a little bit shorter. The cash flow sheet that you provided was very helpful. There was a question if folks would be able to obtain a blank cash flow sheet, and I didn't know if that would be something that would be available in the slide deck or something Andrew's team could put together and share.
Sure, I can put together, I'm happy to do a blank template, and then you can fill items in as much as possible. You really want to customize the cash flow to your particular business. So those are broad categories that I put in there, but at least it can give you a launching point so that you can use to start, that you can start with.
Yeah.
That's great.
And that's something that folks can work with a business advisor on. We have templates as well that are in place. Because as you're kind of working through that, I think the key categories that Orumé had referenced, obviously the things that you want to be able to track longer term to make sure your business is remaining profitable and is remaining, cash positive.
Absolutely. And if you share that with Andrew, I'm sure he would be able to share that as well if you don't get it out in time for the follow-up email this afternoon. Could you offer some tips for a small business owner when deciding the best way to pay themselves?
So when evaluating the best way to pay yourself, you want to look at first of all, you want to look at what your business structure. Are you a sole proprietor? A partner or in an S-corp, and then depending on the main thing depends on what structure you have, what you have, and then obviously, if you're a sole proprietor, you can just take money out of the business as long as you have more than money to pay it, because you're still going to pay tax on your full net income. So you can, it's very easy. That is the most flexible method. The S corporation is the one that gets to be a little bit more complex, because if you're simply paying yourself and taking withdrawals and not paying yourself a salary, the IRS can come back and fine you for penalties and taxes and say, hey, you're providing the services of a CEO. Why are you paying yourself the salary of a janitor? It's not the same thing. So you're going to have to do some kind of analysis to make sure that whatever you, as long as you're paying yourself a little bit, as long as you're in a little bit the ballpark of, if you're performing managerial services, you're in that managerial level, then you can take out the distributions if you have extra resources that you can use. And of course, you also want to look at, is the business profitable? Everybody would love to get paid $1 million. Don't go taking $1 million out of your business if you're not profitable. You still want to, and don't pay yourself all of the money. If you have employees, you want to make sure you have enough money to pay everybody else. So these are things, sometimes you can do the evaluation yourselves. If it gets to be too complex, I would say reach out to an accountant or a CPA for them to help you with that analysis, or one of the business advisors at SBDC.
Thank you. Are there tips you can offer on health savings accounts in relation to taxes?
Yeah, so health savings, that is actually, I do another presentation on this. So there are awesome savings in a health savings account. So I didn't get to, that wasn't part of this discussion. I didn't get to go into that. But usually a health savings account is a triple, it has a triple tax benefit, because when you make a contribution into a health savings account, so if you want to set one up in your business, you should go ahead and do that. It's the contributions you make are going to be tax deductible. The assets, the investments you make, it's going to go tax free. That's the second thing. And then 3, when you withdraw the funds and you have to spend it on health related issues, you can't take the money and go to Alaska or go to Hawaii for a vacation. When you withdraw the money and you spend it on medical related issue, it's tax free. So that's why they call it a triple savings benefits. It's a very good tax strategy that you should definitely implement if you get the opportunity to do that.
Thank you. A quick follow-up on that one. Do you have until April 15th to set up a health savings account? Does that sound right?
To set it up, I want to say, I believe it should be set up before the end of the year. For the retirement accounts, you usually have till April 15th. So, but don't quote me on that. I mean, I can double check that the application deadline and get back to you on that.
Thank you. And if folks are in need of your services and may want to work with you, is the contact information on the screen the best way to get in touch? Yes,
absolutely. Yeah, that is correct. Yeah.
Thank you. Is there a rough magic number for income when you should consider changing your LLC taxation from sole proprietor to an S corp?
I would say, yeah, I would say the ballpark round number would be 100,000. So because of the compliance issue with filing as an S corporation, you're going to incur higher tax preparation fees, higher bookkeeping fees, compliance. You have to file, a regular tax return, and then with the Secretary of State as well, Department of Finance, and then IRS. There's just a lot more compliance and work at the S corp level. So you want to have ballpark figure a net income of 100,000 to be able to justify that, say that the extra costs with the savings. Because yes, you get a 15.3% savings on your payroll taxes, but if you're having to pay out a lot more to be in compliance, that 15.3% all of a sudden it doesn't make any sense.
Thank you. If someone is looking for a CPA to negotiate a reduction in an IRS bill, is that something the SBDC would assist with, or something they should contact like your CPA group for?
I can add, Andrew, that if you have tax relief experts on staff as part of your advisors, but yes, the New York State Society of CPAs, we have a lot of CPAs that specialize in tax negotiation reduction strategies. Most CPAs do perform the services, but we also have experts who specialize. That's all they do in their firm. So if anyone is involved in a complex issue and they want a dedicated specialist to handle their case, we can certainly refer someone to you.
Very cool. I think I got the easy ones out of the way. Andrew, if you don't mind, I'm going to have you follow up with the rest of the questions that folks entered, if that's okay. All
Sure,
right.
that's fine.
Very cool. So if I did miss your question, I do apologize. We'll have the Pace SBDC team, follow up with you. And again, thank you so much for presenting. Is there anything I missed before we shut down?
No, I want to say thank you to all of you, to Andrew, Renee, Jenny, the Pace University, the SBDC, and to Ramona Sedona as well. I'm like, I saw Renee, I was like, so thanks to all of you. This has been a pleasure.
No,
happy
absolutely.
holidays to everyone. Happy holidays.
Absolutely. I like at the beginning, Andrew called us Janae. So I think we're going to sign off as Janae today.
Thank you, Janae.
Yeah, have a great holidays, and we'll follow up with folks on the questions that we missed. I do apologize. I hope you enjoyed today's session. When we shut down, please do complete our survey, and we hope to see you soon, possibly in the new year. Take care.
Okay, thanks.